All right, just a quick fact check here. The president is right to crow about how things are going right now, but I wouldn't say the economy is going in the wrong direction when it came in. Of course, we had an 8-year-long bull market, humming a long year, and well off losing about 1 million jobs a month. But having said all of that, the president, you have to give him credit here for whether it's tax cuts, the cut in regulations. He's given this new legs, this bull market and this economy, and we're seeing it certainly in the retail sector, minus JCPenney. If you look at what we've seen out of Walmart and Home Depot and Nordstrom's reporting yesterday, all far, far better than expected, and a sign that if the consumer is strong and looking to buy and continue to buy, in fact, to double the level and income that we've seen in the past and what was expected, that could be a good sign that this can keep going and going and going. Mike Lee is with us right now, Investmark Advisory Group Principal. Michael, good to see you.
Morning. How you guys doing?
Good, good. Great. So is the consumer. Is that really the lifeblood of everything here? Step back.
I think the only surprise is people are surprised, right? Yeah. So the consumer was doing pretty well under, towards the end of the Obama administration. When you add Samsung, Apple, and Amazon to traditional retail sales, we're growing at 4 or 5% a year, with about 1 to 3% in traditional retail sales and another 2 to 3% in Samsung, Apple, and Amazon when you put them all together. Well, fast forward to the second quarter of 2017, it goes to 6%, third quarter 7%, fourth quarter 8%, and now first quarter this year we're looking at 9%.
So that's sustainable. That keeps going.
Well, what I would tend to say is that the only knock on the consumer is consumer debt. But when you look at household debt, debt service as a percentage of disposable income, lowest level in 30 years. When you
just to clarify that, the overall aggregate debt is still at or near record levels. Yeah, but compared that to assets, ratio, yeah,
right? So debt service, so what it takes to keep the debt going, right, is at the lowest level of disposable income in 30 years. And then when you look at
assets have risen.
Well, also
interest rates have been low.
Yes,
that's in a nutshell.
Interest rates are low. I definitely think they're going higher, but we are nowhere near any sort of consumer debt problem. Debt to assets is also near a 30-year low. So while debt has grown, assets have grown much quicker. Okay, incomes. So when you add not only average hourly earnings and earnings growth, when you add on the additional hours worked plus one-time bonuses and commissions, you're looking at 5% growth year over year. Again, household net worth, all-time highs, home prices near all-time highs. And what I think the market is missing, and most people are missing, is why is this going to decelerate? I tend to think things are going to get better. And why is this happening? As Trump came in and put all these pro-business policies in place, we were sitting on a tremendous amount of cash, not only from the personal side, from the corporate side as well, more cash in the S&P 500 than ever. So you take a pretty good, decent economy, I think better than it gets credit for, and then you just throw gas on it, and now
So how do you play this? What do you like in this environment?
So I don't think retail is going to stop. Okay, I like retail, but I think rates are going higher, so I like things that are interest rate sensitive. I like the big banks. Okay, I think we're going to get 2 more rate hikes this year, 4 rate hikes next year. Okay, what people don't talk about is the discount brokers. They think about those $4.95 trading commissions. It's not that; it's the money market, how they make all their money. And so the higher interest rates are, okay, the more, so they'll pay you 2 when money markets are paying 4 or 5, right? And they'll make that spread. So those spreads just keep expanding. And I don't know how much day trading you do, but
well, I just follow him.
Yeah.
Well,
I just click buy.
And compliance won't let me.
You tend to find that most people that think they can do it themselves end up sitting with a lot more cash than you would normally expect. So those cash balances are always high in brokerage accounts everywhere. And then you look at a J.P. Morgan, a 25 basis point hike from the Fed makes a big difference on a $1 trillion balance sheet. So I'm big on the banks. I think.
And on J.P. Morgan's point, they're actually buying back their stock pretty significantly, and this is one of the months they're doing it. So they're lending in and supporting the stock, if you want to think about that. And buybacks have been demonized, but a buyback is a is a tax-free dividend. Because dividends, when they're paid out, they're double taxed, meaning the company's already paid taxes on it. They give it to you, and then you got to pay taxes on that. So why wouldn't they buy back their own stock? They don't need to pay taxes on that transaction.
And in addition to those buybacks, I think Mike is onto something that people are not talking about enough. For the last 10 years, a huge part of the bank earnings machine has been earning a spread on their money market balances and their checking account balances. That has been zero because interest rates have been zero. As we get a decent interest rate on the short end, there is a huge amount of untapped earnings power that comes back into the banking system.
Can't they invest in anything, though? Isn't that the whole idea of this?
So we are starting to get a loosening of the macroprudential. So the problem with the financial crisis is banks were to blame partly, but not entirely. And so you came in and you overregulated, which stifled the growth of capital, okay, and the free flow of money. So that regulation is being reduced. And as spreads widen on net interest margins, banks can take more risk because there's more cushion. So you're going to see a greater velocity of money in the economy from the banks, okay? As rates go out, you're going to see more volatile moves in commodities, in stocks, in bonds. So the trading departments are going to make more money. They're going to lend more at higher margins. I think we're entering a golden era for the banks. We haven't quite seen it yet. You know, the Fed owns too many bonds in the long end, which is, you know, manipulated the yield curve to be much flatter than it really should be right now. But
flat it is.
Yeah. So. It is flat, and I think at some point the difference between the short end and the long end has to have a relationship between inflation and GDP. Inflation is going higher, GDP is going higher. We are not in a decelerating economy. We are in an accelerating
So this doesn't accurately reflect what's really going on.
No,
okay.
I think that one of the most dangerous securities out there is the 30-year Treasury.
Wow.
Agreed.
Okay. All right, Mike, it's great seeing you. Thank you very much.
Thanks so much for having me.
You know your stuff, young man.
Yeah.